This is an analysis from Alpha Business Media.
You know, there's this specific kind of cognitive dissonance you get. It happens when you read a financial report in the morning with your coffee, and then you actually walk down the street in the afternoon.
It's the classic, who are you going to believe, the spreadsheet or your own eyes moment.
Right, because if you look at the official data coming out of the Nepal Rastra Bank right now, the banking sector looks surprisingly bulletproof.
It looks solid.
We're seeing a non-performing loan ratio, or NPL, of roughly 4%. Now, considering everything, the global tightening, the post-COVID hangover, that 4% feels like a victory lap. It sounds manageable.
On paper, it is. It's a statistic that says nothing to see here. The system is robust.
But then you go out. You talk to anyone actually doing business in Kathmandu or Pokhara. You see the shuttered storefronts. You see construction sites that have been silent for months.
The cash has just dried up.
Exactly. There is a massive liquidity crunch on the ground. So the mission for this deep dive is, well, it's pretty simple. We need to figure out why the map doesn't match the territory.
And the answer, I think, is pretty uncomfortable. The sources we've pulled for this suggest that the 4% NPL figure is essentially a lagging indicator. It tells you what broke a year ago.
Not what's breaking now.
Not what is cracking right now, just under the surface.
So we're looking at the tip of the iceberg.
We're looking at the tip. The dangerous part, the part that sinks ships, is that unquantified pool of bad debt hiding below the surface. We need to talk about the NPLs you cannot see.
And this leads us to a term that keeps popping up in the research. Evergreening. It sounds nice, doesn't it? Sounds sustainable, like a pine tree.
Yeah, it's definitely not about sustainability in the environmental sense. In banking, evergreening is more like, imagine you have a house with a rotting support beam.
Okay.
Instead of fixing the beam, which is expensive and messy, you just slap a fresh coat of glossy white paint on it.
So the inspector walks by, sees the white paint, ticks the box, and moves on.
Precisely. But the house is still falling down. You've just hidden the evidence.
So let's strip the paint. How does this actually work in a Nepali commercial bank? This isn't just ignoring a payment, is it? This is an active financial maneuver.
It is. It's very active. The technical term is extend and pretend. But the mechanism is often deceptively simple. The sources point to a specific structure involving working capital loans, that is...
Well, let's just say it's prevalent.
Let's use the example from the research notes, the hotel project. I think this really makes it clear, especially because that sector was hit so hard.
Sure. So let's say it's 2018. You're a developer. You borrow 1 billion rupees to build a luxury hotel. The projections look great.
Tourism is booming. Everything's up and to the right.
Exactly. Your business plan says you'll be at 80% occupancy by 2020.
Then 2020 happens. The world shuts down. Tourism goes to zero. Even now, maybe you're struggling to get back to 40%. You simply do not have the cash flow to service that massive debt. You're underwater. And in a healthy, transparent market, the bank would have to make a hard call. They'd look at your books and say, this project is distressed.
You can't pay.
You can't pay.
Right.
They'd have to classify the loan as non-performing, take the loss, maybe force a sale.
Which is painful for everyone. The developer, the bank, the bank manager.
Right. And banks hate pain. CEOs really hate reporting losses, so they come to you with a solution. They say, we won't mark this as a bad loan. Instead, here's a new loan for 100 million rupees.
Now, what do they call it?
They'll label it strictly for business expansion or additional working capital.
Wait, but the hotel doesn't need working capital. It has no guests. It doesn't need to buy more towels.
It doesn't matter. The bank deposits that 100 million into the hotel's account. And then, and this can be just hours later, the hotel transfers that 100 million right back to the bank.
To pay the overdue interest on the original loan.
Exactly.
That is diabolical. The bank is paying itself with its own money.
Correct. They move money from their left pocket to their right pocket. But on the balance sheet, it looks like a miracle. The borrower is current. The loan is performing. The NPL ratio stays at a healthy 4%.
But the bank's real exposure just went up. They used to be on the hook for $1 billion. Now it's 1.1 billion.
And the underlying asset, the hotel, is just as distressed as it was yesterday. The problem hasn't been solved. It's just been compounded. They've bought time, but on a credit card with a very high interest rate.
I have to play devil's advocate. Why would a bank CEO do this? I mean, these are smart people. They know the math doesn't work out forever. Why risk everything just to delay the hit for a few quarters?
It's not just about ego. It's about the P word. Provisioning.
Okay, let's break that down. I think this is where the average investor gets lost. What actually is provisioning?
Provisioning is the capital a bank has to set aside. You can think of it like locking money away in a vault to cover potential losses.
Yeah.
This money comes directly out of their profit. It's an expense.
Okay.
And under the NRB rules, the penalties for bad loans are steep.
So walk me through the math.
If a loan is marked substandard, meaning payments are overdue, you have to provision 25% of the loan value.
25%. So with our hotel example, if they admit that 1 billion rupee loan is bad, they have to lock away 250 million rupees. Instantly.
Yep, that's 250 million wiped right off the bottom line for that quarter.
That murders a quarterly report.
It destroys it. Executive bonuses are tied to net profit, share prices are tied to it, and it gets worse. If the loan slips to doubtful, that's a 50% provision.
Wow.
Loss is 100%.
But if they ever green it, if they use that fake working capital loan to keep it looking green,
The provision is only 1.3%.
1.3 versus 25, I mean, that is a massive, massive spread.
It's an irresistible incentive to, let's say, massage the truth. By avoiding that 25% hit, the bank reports artificially high profits, they declare dividends, they keep shareholders happy.
But they're paying those dividends out of a hollow shell. They're distributing capital that should be sitting in a reserve, guarding against the inevitable default.
That's it, exactly. It's a wealth transfer from the future stability of the bank to the current pockets of the shareholders. And when the music stops, there won't be any chairs left.
And the regulators. At NRB, surely they can see the same data we can? You can't hide a hotel not having guests. Why isn't this being stopped?
This is where it gets tricky. The sources call it regulatory arbitrage. The current regulations are largely backward-looking. The computer algorithm at the central bank just asks a very simple question. Did the borrower make the payment on time?
And because of the new loan, the answer is yes?
Exactly. The computer doesn't necessarily ask, where did the money for the payment come from? As long as the paperwork is filed correctly, business expansion, the regulator sitting at a desk sees a compliant bank. The letter of the law is intact.
But the spirit is shattered. This creates a really dangerous paradox for investors, doesn't it? Because if I'm looking at Bank A and they are honest and they take the hit,
They look terrible. Their profits tank, their dividends get cut, their stock price drops because they're doing the responsible thing and cleaning up their mess.
meanwhile, Bank B, which is evergreening everything in sight, reports record profits and a huge dividend yield.
And that's the provisioning paradox. The most reckless banks currently look the most attractive to an unsophisticated investor. If you are just screening for dividend yield right now, you are statistically likely to be buying into the banks with the biggest hidden problems.
That is a terrifying thought. You're buying the illusion.
You're buying the pain, not the beam. And eventually, gravity always wins.
Now, history has a way of rhyming. This situation, extend and pretend, hidden NPLs. This isn't unique to Nepal, is it?
Not at all. Not even close. If you want to see how this movie ends, just look south. India, roughly 2014, 2015.
Okay, set the scene for us.
It was eerily similar. You had official NPL failures in the Indian banking sector that looked fine, around 4 or 5%. But everyone on the ground in Mumbai knew the truth. There were these zombie corporations, massive infrastructure groups, steel plants that hadn't generated real cash in years.
But they were being kept alive by the banks.
Kept alive by evergreening. It was a conspiracy of silence. The banks didn't want to admit the loans were bad. The government didn't want to admit the economy was stalling. It was a standoff.
So what broke the cycle? What changed?
A man named Raghuram Rajan, he was the governor of the Reserve Bank of India. He basically realized that if this continued, the entire Indian financial system would lose all credibility. So he stopped asking nicely. He ordered a mandatory asset quality review, an AQR.
Now, when I hear review, I think of a checklist. This was something
Oh,
different.
this was a raid. It was a forensic audit. The RBI sent inspectors into the banks with a very specific, ruthless mandate. Ignore the payment history. Look at the asset itself.
Look at the project.
Yes. Is that power plant built? Is it selling electricity? No. Then it's a bad loan. Mark it down now.
Even if the borrower had technically paid their interest yesterday with a new loan,
Didn't matter. They looked at the actual cash flow, not the payment receipt.
that must have been a bloodbath.
It was carnage. In 18 months, the official gross NPAs in India jumped from 5.1% to over 9%. For the public sector banks, it hit 12%.
That's almost double.
Almost double overnight. The illusion just evaporated. Profitability collapsed because banks suddenly had to make those massive provisions they had been dodging for years. Major bank chairmen were fired.
And here's the key question. Did it work?
It saved the system. It was painful surgery, but it removed the cancer. It forced the banks to recapitalize, to go out and raise real money, clean up their books. Today, the Indian banking sector is incredibly robust because they took that medicine.
And the sources are suggesting this is the blueprint for Nepal,
Yeah.
that we are basically India in 2014.
It's the only rigorous path forward. We are currently in the denial phase.
So let's game this out. We're standing here today. What are the scenarios for Nepal? Can we just keep denying it?
Well, we have two paths. Path one is the muddle through strategy. The NRB decides it's too politically dangerous to rock the boat. They let banks keep extending and
But
pretending.
what does that look like for the economy?
It looks like Japan's lost decade. You get a banking sector that is technically alive but practically dead. They're so terrified of their hitting bad loans, they stop lending to new businesses. They stop taking risks.
So the zombie firms keep getting fed, but the new innovative companies starve.
Exactly. The startup doesn't get funding. The small business doesn't get a credit line. The economy just stagnates for years. It's a slow suffocation.
That sounds depressing and probably not sustainable.
Which brings us to path two, the Big Bang,
The AQR.
the inevitable asset quality review. Most analysts and the sources we're looking at believe the NRB will be forced to implement a strict India-style AQR within the next 18 to 24 months.
Why not?
The pressure from international bodies like the IMF and the World Bank is just getting too high to ignore.
Okay, I'm going to pause here and talk directly to you, the listener. Because if this big bang happens, it's not just a headline, it's going to hit your portfolio. Walk us through the cascade. The NRB announces the AQR tomorrow. What happens next?
There are four distinct shockwaves you need to be ready for. First, obviously, is the NPL shock. The official ratio isn't staying at 4%. It's going to 8, maybe 10%. For some banks, maybe higher.
So the headline number doubles. Panic sets in.
That triggers the second shock, the profitability collapse. Remember the provisioning rules? That 25%, that 50%, all those provisions kick in at once. You will see major banks reporting quarterly losses, not just lower profits, actual losses.
And if there are no profits?
That's shockwave number 3. And this is the one that really hurts retirees and income investors, the dividend drought.
Right, because legally you can't pay out what you don't have.
Exactly. If a bank has no distributable profit, they cannot pay a dividend. So that 12–15% yield people are chasing right now.
Goes to zero.
It goes to zero, likely for at least a couple of years while the bank rebuilds its capital base. If you are relying on those dividends, you need to understand that income stream is incredibly fragile.
And the fourth shock?
Consolidation. Some banks just won't have the capital to survive the hit. Their capital adequacy ratio will drop below the legal minimum,
So they'll need a bailout.
or they'll be forced to merge. They'll have to issue rights shares, forcing you, the shareholder, to put in more money just to keep them afloat, or they'll merge with a stronger bank.
And these won't be happy marriages.
No, these will be shotgun weddings. Weak banks get absorbed by strong banks at very unfavorable valuations. If you hold shares in the weak bank, you're going to get diluted significantly.
This paints a pretty bleak picture for the short term. The era of just throwing a dart at the Nepal Stock Exchange and hitting a 15% return it's over.
Completely. The tide is going out, and we're about to see who's swimming naked.
So what is the strategic takeaway here? If I'm an investor listening, do I sell everything, put my money under a mattress?
No, panic is never a strategy. But you have to stop chasing yield. You have to be counterintuitive. Right now, investors are punishing banks that report high NPLs. But ironically, the bank reporting 6 or 7% NPLs today might be the safest bet.
Because they're already telling the truth.
Exactly. They're taking the medicine now. Their balance sheet is cleaner because they've already acknowledged the rot.
So you want to look for the banks with conservative management, high capital ratios, and yes, maybe lower dividends today.
Because the bank paying a huge dividend while having suspiciously low NPLs, that's the one holding the dynamite.
It's a complete reversal of how most people think. You want the bank that looks a little ugly today because they'll be the only one standing tomorrow.
Precisely. You want the bank that has already done its own internal AQR before the regulator forces them to.
It feels like we're standing on the edge of a cliff, waiting for the ground to crumble. But I guess the point of this deep dive is that the crumbling is actually the solution.
That's the thought I want to leave everyone with. The AQR, when it comes, is going to be painful. The headlines will be scary. But don't mistake the surgery for the disease. The disease is the hidden bad loans. The evergreening is the infection. The AQR is the cure.
The question isn't if the bubble will burst.
The question is your portfolio positioned for the reality that is coming, or are you still invested in the illusion?
A sobering question to end on. We'll be watching the NRB's next moves very closely. Thanks for guiding us through the fog.
Thanks for having me.
And to you, the listener, check those balance sheets. Look beyond the white paint. We'll catch you on the next deep dive.